To the head of research at Credit Suisse, we have Giles Keating on with us, and Giles is pretty optimistic considering you think there's more scope for gains for equities going forward.
Yes, I do think the trend is still upwards. I mean, of course, there are a lot of worries, whether it's sovereign debt, whether it's monetary tightening, and that'll create volatility, but I think the trend is upwards.
Yeah, and why do you think the trend is upwards? As I mentioned to you, recently we spoke to Martin Feldstein and also Laura Tyson, who says that there are still risks to the U.S. economy and also, I guess, incidentally, to the global recovery as well.
There are two reasons why I'd see the trend is up. One is I think equities are somewhere close to fair value. Of course, you can look at different measures, but if you average them out, somewhere close to fair value. And during the upswing of the cycle, you tend to go above fair value. And the second reason is I do actually think the world economic recovery is pretty robust. Clearly, in the emerging markets, there's enormous strength, enormous momentum. But even if we look at the US and Europe, we're seeing a transition away from just the inventory cycle over to something more durable as corporate spending and even consumer spending begin to rise.
Yeah, that's really interesting because both Feldstein and also Laura Tyson mentioned that the U.S. consumer is still a little constrained and manufacturing isn't coming back as much as they would like in order to see robust recovery. They wouldn't actually use that word. So what makes your views a little different from theirs then?
Well, I guess if I look at the short-term manufacturing indicators, the business surveys, I do see that those are not quite as high as they were, and I'm pleased by that because that says to me we're no longer just being driven by inventories. We are moving to that more sustainable phase, which has to be a bit slower. You can't keep having global industrial production rising at an annual rate of over 15%, which we were. If I look at the jobs market in the US, then although the overall payroll hasn't started to go up, the temporary jobs have moved up very strongly, and they are a clear leading indicator. And again, the business surveys, almost all of them are showing employment leading indicators pointing upwards.
Let me ask you about fair value, because it's interesting that you mentioned fair value, because that's pretty hard to gauge these days, don't you think? I mean, some say it's pretty expensive, some say it's cheap. How do you see that it's fair value? Stocks are at fair value.
I guess take the view that you have to look at a range of measures. I think if you simply look at one measure, you can basically pick which measure you want to reach the conclusion you want. So we typically look at 5 different measures. We'd look at 12-month forward price earnings. We'd look at 10-year trailing price earnings, and we would adjust that for the economic cycle. Market cap to GDP. We look at the equity risk premium. And then finally, we take a very long-term trend, which my colleagues have generated 160 years of data, and you look at deviations from that, and we're still quite a long way below trend on that last measure. So some of these measures a little bit above, some a little bit below. I think the overall picture is we're somewhere around fair value. You can never be precise.
Yeah, okay, well, let's take a look at your equity market preferences or indications. How about that? Looking at on a 6-month view, looking at your latest report, it looks like total return might increase for MSCI UK, MSCI Japan, and MSCI Emerging. Okay, Emerging makes sense because it seems to be a consensus that a lot of investors are looking for more gains in those two markets. But the UK and Japan, some would say these are really weak economies right now. So why should we be looking at equities in these two markets? Yeah,
well, the UK, of course, the index is heavily dominated by energy and international-oriented companies, much more so than the domestic ones. And that's one of the main reasons why we favour that. As for Japan, of course, people always tend to look at Japan at the beginning of the year. It is a market that has lagged, and I think I would add to that the Japanese economy is perhaps not quite as down in the doldrums as people think. In fact, some of the recent indicators have been significantly better.
Does that include the export numbers that we got this morning, a 45% acceleration in export figures for the month of February? That's a year-on-year figure, though. It came from a pretty low base a year ago.
That's true, but I mean, remember, everything in Asia is just moving up very strongly from a low base. And I think Japan is clearly taking part in that broader economic recovery there. We've also seen some of the domestic indicators just looking a little bit better than people had expected. There's so much gloom about Japan. I think it's just gone, as so often happens in markets, a little bit too far.
Now, let's isolate Japan and the UK. Are there any preferred sectors here? You mentioned energy seems to be playing a heavy part of the UK market. What about Japan?
Well, in Japan, it continues, of course, to be some of the export-led sectors. But as I say, we also think that there are some domestic sectors which have just got beaten down too much.
Such as, do you mind if I ask?
Yeah, I mean, we can't go into individual names,
right.
but I'm saying some of the stocks that point towards the domestic economy. Yeah.
Okay, I tried there, Giles. Let's talk about the emerging markets then, because you see obviously growth for emerging markets. Are there any ones in particular that you favor more than others, shall we say?
Yeah, no, we continue to favor China, and I mean, in a sense, that one is a story which everybody talks about, but we just think there is still value there, and we don't think that the market, although it's been erratic, but it has moved up, we don't think that it's yet overstretched by any means. Elsewhere, I mean, we have a number of emerging countries around the world, not just the very biggest, but we'd certainly keep an eye on Indonesia, on Turkey. These are all markets that we think can, at the very least, take part in the general continued rise in the emerging market universe.
And how about in the BRIC universe? Of course, you mentioned China. What about Russia? What about India? And yeah. Yeah,
I mean, look, Russia remains looking very, very cheap on conventional valuation measures. But I think the danger is it's likely to stay that way as investors just remain concerned about governance issues. But Russia will continue to benefit from the strength of the commodity markets, the strength of the energy market. India, I think, again, looks reasonably well valued. Brazil, rather the same. I mean, that's why we prefer China out of the BRIC group.
Okay, all right, Giles, we're going to go to a commercial break. When we come back, let's cover currencies and maybe a little bit of commodities as well. We're talking to Credit Suisse's head of global research. We're talking to Giles Keating here live at the 13th Credit Suisse Asia Investment Conference.